Welcome, everybody. We see people connecting and getting logged in, and we're trying to zoom in our great guest today, Jason Howell, Mason alumni of Jason Howell Company. We want to thank you for coming to this session that's part of our inaugural Business of Wellbeing Week. For those who don't know, we have a Business of Wellbeing initiative focused on understanding the businesses, the entrepreneurs, the concepts behind the business of well-being. You might ask what well-being is, and that is a great question. And we actually had to ask that a couple of years ago. And fortunately for all of us who are part of the George Mason community, we do have a Center for the Advancement of Well-Being here at George Mason. And they spent a lot of time, I think, with a lot of big brains to come up with a very simple and concise definition of well-being. And that is building a life of vitality, purpose, engagement, and resilience. And that's a great, important starting point. But when it comes to the business side, how does that actually play out functionally? And we've identified 6 different areas where you might find products or services to help you or an organization with well-being. And that's emotional and spiritual, physical, financial, which we're going to talk about today, occupational, place-based. Do you have a wonderful home or a place to work or parks to wander through? And then social. Do you have a community, a family, friends, support? So those are the 6 areas. And this week is dedicated to understanding and exploring those. We're very fortunate to have an alumni like Jason, who's active in the business of financial well-being and helping people and families get their financial house in order so they can live better. I mean, that's the goal. And so today we have Jason, like I said, and we're just going to have a little bit of a Q&A. I'm David Miller, the Executive Director of the Center for Innovation and Entrepreneurship. And we've got about 45 minutes slotted today. And we're going to spend about 5 or 10 minutes just on this introduction, Jason introducing himself. Then we'll get into the meat of the conversation. I'll ask Jason a range of questions about his experiences in entrepreneurship business and the business of financial well-being. And then for the last 15 minutes or so, we'll open it up to everyone and see if you have any questions for Jason or maybe even for each other. This is a great opportunity for all of us to learn together. So with that, I want to welcome Jason and then ask him to briefly introduce himself and briefly explain his path to entrepreneurship. Welcome, Jason.
Hey, thank you, David. Thank you so much. You know, my path to entrepreneurship, I'd love to start there. I wanted to be an entrepreneur for many years before I even transferred to George Mason back in the 90s. And, the funny little story about that I had written in my book was, I was sitting in the basement and I had all of these magazines, small business opportunities, all these different things I was sifting through. And my dad comes walking downstairs and he just says, hello. And I said, Dad, I don't think I'm going to transfer anywhere. I think I'm just going to be an entrepreneur. And he looks right at me and he says, how about you go ahead and go to school? I'm like, okay, but I was going to just be an entrepreneur. I'm glad I went to school. I'm glad I went to Mason and had a great experience and got some undergirding of my entrepreneurial endeavors because it took me a long time to actually figure it out. I was no Zuckerberg. So all the accounting I learned at Mason, all the relationships I built at Mason, critical for eventually succeeding in this thing called entrepreneurship so many years later. But I cut my teeth in the 90s. It's why I own jasonhowell.com, because I bought the URL back in 1999. And I took that, and my first business was an accounting firm for unsigned musicians. And I was the only accountant working with unsigned musicians. Then I realized why I was the only accountant working with unsigned musicians. There's no profit in unsigned musicians. So not that successful a business, except for the fact that I got to know a lot of cool rock stars and hang out with them and be a part of their dreams and their journey and their entrepreneurial endeavors. So still a very exciting time for a number of years to be in that space and trying to help other people achieve their dreams. So I'll flash way forward to now. Being a financial planner, I own Jason Howell Company, a family wealth management firm based right here in Vienna, Virginia. Like a lot of financial advisors, my job is to help the rich get richer. What I hope to do on top of that is to create essentially a rich life for these folks that includes giving back to the community and building in the kind of values that got them to where they were today throughout their family, so that their families can become true stakeholders of the community. I hope they all become patriarchs and matriarchs of the community, taking responsibility for the ills and the challenges that we face and trying to make them better, on top of trying to get them the kind of performance in their portfolios that would make them happy. But of course, these days, also looking at environmental, social, and governance factors that can even make their investments part of the solution. So that's a little bit about me and my firm.
Excellent. A lot in there, and I took some notes because there was a lot, and I always say this every session. I hope everybody's taking notes during these sessions, and there's value to actually writing down. Yeah, I believe you remember these great insights. So I'm going to go back a little bit just because it is important. I think we have some students here. You did reference your experiences at Mason, and that's something we're always trying to remind students is take advantage of this ecosystem here. And you mentioned just the classes, for example, accounting, things that actually were directly related to your career. But then you also mentioned a couple things that led to people and your engagement with meeting people and networking, the kind of the other side of this, just not the core skills. Anything specific you want to tell about your experiences, clubs or activities you did that might put a little color in that?
So easy to do. I didn't want to go to Mason. That may not be the case for a lot of people who attend Mason now, but in the 90s, it wasn't my first choice, even in Virginia. And my sister went to Mason. My sister also went to Nova. And so why would I want to follow directly in my upper siblings' footsteps, But I did. And I was rewarded with that decision by the opportunity that Mason certainly afforded then. And my guess is, from all the involvement I've had as an alumnus, still affords now. I had the opportunity when I was just starting to work with unsigned musicians at Nova. I came to Mason and I got to be on the program board, which allowed me to be director of concerts, which was ridiculous. That wouldn't have happened if I went to some of the older institutions. There's no way it would have been some transfer student gets the opportunity to get involved and be the head of the person who books, or the head of the school that books bands and artists on campus. But I was. The Johnson Center had recently opened. I got to book the basement of the Johnson Center every Wednesday and Friday night. I got to book the show for the, what do they call it? It's the once a year event, not Mason Fest, but yeah, you guys know the name. You'll know the name, David. What's that annual event that they have?
Mason Days? Is it international?
Mason Day. Yeah, that's it. I got to book the Violent Femmes for Mason Day. Wow. Spent a lot of money on them. And it was just terrific. And when I graduated from Mason, as I like to say, I got to take the relationships that I had built while at school, while as a part of the program board, and continue locally in Fairfax and in DC and in Arlington to book unsigned musicians, because I had relationships that I carried with me. I had relationships with booking agents that I carried with me. I had relationships with other musicians who were on campus that wanted to get booked outside of campus. In fact, I also wrote for what was called the Broadside. Now it's called the Fourth Estate, your student newspaper. But at the time it was called the Broadside. And I got to write articles about some of the musicians that I worked with. There was also a newspaper called University Reporter that went out to a number of universities. And so I took my writing acumen, which I happened to have. You wouldn't see that manifest in accounting, but that was something that I could do. And I wrote about these musicians in University Reporter. And so I got opportunities for these musicians while I was in school, which only helped my credibility when I graduated to say, yeah, that's a guy that can help us. Let's support him. Let's ask him to be our manager. Let's do all these things. And so there were a lot of opportunities just by getting involved at Mason that allowed me to carry those experiences to real life outside of school.
It's amazing. It's just a reminder, when I think of that definition our colleagues put together, keyword is engagement, and you have to be engaged with the world. You have to be engaged to pick up skills and create networks and learn. And if you're smart, like Jason, have fun. I have a feeling that was a lot of fun meeting those bands and booking them and
Yes.
meeting all the people involved in that, and writing skills. I mean, that's another amazing thing, that you're an accountant, but you're doing things that demand writing skills. I everyone go write for the Fourth Estate, please. I beseech you all as an instructor, go write as much as possible, because it does still matter. So thanks for just sharing that, because I think that's important. Again, for the students who are on, to know that not the pressure, but it starts now. There's a whole world of opportunity around you on campus, and just waiting for you to get involved and just get engaged on that. So you get into accounting, and then you obviously make a switch from accounting into financial services, financial advisory services. And then you pointed out that it is about, one thing you said, helping the rich get richer, but then you went much deeper. You started talking about ESG. So you start, it sounded like, from a place of helping individuals or families with financial well-being, but even the way you deploy it seems to have broader well-being implications. Can
Yeah,
you
it
talk about
does.
that? How you kind of go beyond helping the rich get richer, and what that means exactly, and how you measure those things?
Yeah, and I'll connect it to the time when I was managing bands. I got my first band managing opportunity because I was the only one in the bar with a shirt tucked in. That was just my deal. Okay. And so I was probably the only one with as a business major.
Got
So
me a little
David,
nervous
what's
right
up?
now. I'm sorry.
Yeah, you clean up, David. You don't
I
know what
was
kind of
trying to
opportunity.
show the Mason Esports logo,
Oh, you got, I see. You
but
got reasons.
apparently I
Makes
forgot.
sense. But yeah, dress the part. I wasn't doing it intentionally. I was just a nerd. I worked in banking while I was at Mason. So, 3 days a week, 4 days a week, actually, I was, had a suit and tie and suspenders because it was the 90s. And so to come on campus with a t-shirt, I mean, that was still tuck in material time. So that was the deal. But, the first band asked me to manage them and said, "Oh, wow, we'd love for you to work with us." I'm like, "All right, I'll do it." But then that same, accounting experience, I was the only accountant in the bar. And so, yeah, I'm going to do the accounting for the bands and help them do what they wanted to do, which every band wanted to get signed back then, signed to a major label. But they were a business. And if they didn't position themselves like a business, as many of you have anecdotally heard about musicians who have gone bankrupt, even with hit albums, if you're not a business as a band, you could get signed, which really just means get funded, and then have the worst contract that takes advantage of you at the worst time, which is basically those great songs that you wrote, in your basement a long, long time ago. So I was doing this, essentially this sort of well-being work, because I was working with these musicians, providing a little bit of stability to them in a way that they wouldn't have had otherwise. And it was wonderful work. I did not make almost any money, far less a lot of money, or even a little money, just a tiny bit of dollars. But the work itself was so valuable because it was an opportunity for them to get to the point of being able to succeed. As a financial planner, it's similar in some senses. I started my own firm because I didn't want to have to work with multimillionaires. I wanted to be able to spread the financial love and knowledge to everyone, much like I did with the musicians. But I learned a lot more quickly in this role than I did in that role, that, working with the musicians that are actually successful from the jump would have been a much maybe cleaner way of getting there. And as a financial planner, that is actually the business. It is the wealth management business. And so most of the clients of financial planners are going to be people who did do a lot of things right financially, and they're trying to ensure that they continue doing the right things as their money gets more complex, as their goals get more complex. And so we bring our expertise as financial planners to that. But if we have an even broader mindset, which we do at Jason Howell Company, we connect their values to what they're doing with their money. So we're one of the few firms in the area that's going to work through this family governance procedure with each of the families, and especially the parents. And we come out of that with what's called a family constitution, which identifies what their values are, what their family mission is, how they would execute those values using the recommendations they have from the financial plan, and how they manage their money, and ensuring that their children understand. And a lot of times we work with adult children of these parents, that they understand where it came from. So many people who've had financial success, they kind of did it on their own. And it's really difficult to communicate how they did that to extended family and even nuclear family. And so what we do is we work to share the experiences of the work ethic, and again, the standards that they held as a family, the values that they want to, promulgate as a family. So that is understood by that next generation, and then they can take that forward and become stakeholders not only of the family, but also of the community.
Thank you. Really, just for those studying entrepreneurship or really anything, you can hear the focus and the differentiation. I don't know everybody locally, but even when you think about services that advertise nationally, you don't hear a message is that focused and that specific. And I think just for those who are studying entrepreneurship and business models and innovation, that's where you see in real life it plays out, the differentiation, the unique value proposition in detail here. So that's really fascinating. And it is interesting, that you mentioned that people learn to create wealth, but then it's a question of preserving it. That's a different level of financial well-being, maybe, that you're educating them on. Talk about the industry itself and just how it's evolved. I open, and my students bring it up, and we talk about it. You open up today and you've got a Coinbase IPO, and you've got NFTs, I don't know if the digital trading cards, and and it's just, the stock market's at an all-time high coming out of the worst year we've had in a century. And so it's just kind of, how do you as an entrepreneur in that space, make sense of all these things going on? And then how do you communicate with your clients on these things?
Understand that every entrepreneur is essentially an amateur, microeconomist in some ways. And what that means is there is a financial element to what you're doing, but there's also an emotional, psychological, behavioral element to what you're engaging in, because you're engaging in business, assumedly solving someone's problem. And so there is a factor there that you're trying to figure out that would ensure that you're delivering value. I mean, that's what a business owner does. You deliver value by solving problems. I've heard it said, you want to make $1 million, solve 1 million problems, or a problem for 1 million people. You're done. It's not that difficult. The difficult part is getting to scale to solve 1 million problems or one problem for 1 million people. That's the difficult part. But as far as figuring out what to do, start with the problems and go for that. This industry is a fascinating industry because it has grown so fast in a short period of time. People weren't always selling stocks and bonds and, life insurance policies. As far as life insurance policies, that's only about 175 years old. You're, oh, wait, that is forever. Oh, yeah, it is. The country is only about 250 years old. So as far as relation to the country, it's a long darn time. New York Life celebrated 175 years this year as far as being in business. That was what the industry was, though, for so long. It wasn't until the middle of last century, the 20th century, that this idea of investing became a big thing for your grandparents and your parents. It wasn't until the Revenue Act of 1978 that actually created the opportunity, or at least highlighted the opportunity, in IRS Regulation 401k, for employers to offer this retirement account that people could put some of their paycheck in. That was 1978. It didn't really start till 1981. Then in 1986, you got the TSP for federal governments. And so the whole idea of doing pensions went away, essentially, very quickly. And it became this, hey, save your own money. Well, how do I save my own money? Well, you invested in the market. Oh, the market? The stock market? Yeah, that just happened like 50 years ago, that it became this national push for people that are not involved as professionals in this business to get involved as consumers in this business. And so it's a relatively young industry. And the way it started was with a lot of sales. And with those sales and with those opportunities for growth, you got all kinds of people. You had people who were really into it for the right reasons, like every industry. They wanted to help facilitate and solve the problem of getting you from here to there in your retirement, maybe, and help you make some more money with something you don't understand. And then you had people who did it for nefarious reasons. They just wanted to get rich. And so they picked this one because they didn't want to pick something else. And, they got rich. And so they sold insurance policies and they sold master limited partnerships and they sold stocks with huge commissions on the trades. And they did other things, Ponzi schemes that were terrible. Bernie Madoff died today. Just came across CNBC. He died today. What a guy, right? The things that he did in this industry that put him in jail because of what he did to families and nonprofits with their money. And so there's a terrible reputation for financial advisors, but there are many people who do this for the right reason. And what gets me so excited about sustainable and responsible investing, not that it's new, but because it's starting to get more popular. So people one generation above maybe your classmates, millennials, Gen Xers like you and I, David, certainly women as a monolith, high net worth individuals, they are all asking their financial advisors, institutional investors are all having these requirements to say, we need to keep an eye on, yes, performance, but also how these companies we're investing in are affecting the rest of the community. That gets me very excited because now we can repurpose this expertise. And I've got a lot of expertise in this financial world, but to repurpose that on stakeholder capitalism, that's such a great opportunity for all of us.
Great. And I'll ask one more question, and then if people have questions, they can put in the chat box or raise their Zoom hand. I think it is, your focus is congruent with right where society's moving, where we are asking more questions about whether it's, our investments, and like you said, this is still very new as an industry. Is there something, or, I know we have, again, a lot of students and people who may be invested, for their own well-being, resources they can look for, their specific books on, the ESG, SRI angles, that some people may want to do, or websites for those who are kind of want to start looking that way?
Yeah, there are a number of them, and I tell you, this is something that I figured out just sort of going into this more aggressively last year, that there was so much available, but if you talk to the generic financial advisor, which is essentially what you alluded to, David, that you don't hear some of these value propositions. You don't always hear this from other financial advisors in regards to SRI investing. You're not going to get that same maybe passion that I'm going to come to the table with, because there is this assumption that it's nascent and it's novel, like the coronavirus. It's a brand new thing. Get excited. But, we've been doing analysis for a number of years and we're going to do it this way because it's more proven. Well, the reality is this kind of investing, this kind of attention has been with us for centuries. And it's only in recent years, really since the 2008 crisis, that it's sped up in this country as a way to invest and a way to be a part of this. So how do you get more involved? How do you get more educated? Of course, get more educated. USSIF.org is one place you can go. It's the Forum for Sustainable Investing. And what's neat about USSIF.org, in fact, I think I might have the full URL for this. They actually have a course for individuals where, it's a half an hour. Well, it's not a half an hour. Maybe it is actually a course where you can learn some stuff. It's free. Okay. So you can go on for free and get a basic understanding of the different ways that you can invest according to values that you hold dear, not anybody else, but you hold dear. Another great website to go to that can give you some historical perspective and more information is asuso.org. They are specialists in this area, and they put out their own data for different companies and exchange traded funds about what you can expect if you are investing or not investing in any of these funds. And so start there. Certainly that ussif.org, there's more content on there than I can read. I went all the way and got a designation, which is the Chartered SRI Counselor, CSRIC. And it's designed for financial advisors to get a baseline. It's a pretty pretty thorough exam. I don't think you need to do that, but if you wanted to, you could actually get that designation. I don't think they're going to stop anyone from paying the $1,300 and going through the contents. You could go that far if you like, but start with that baseline at US CIF and just read through the US CIF website. You'll get educated, and it'll mean a lot to you as you start investing.
Excellent. And I see we have a question, and maybe it's my fault for asking about NFTs. I can't contain
It's
it.
okay.
Are your clients asking about them? Are they like, because I remember when Bitcoin was 600 and I'm kicking myself right now.
I know.
Are you kidding me? So what do any thoughts? And again, you have a very particular focus, so it
Sure.
may be stuff you guys don't even talk about.
We talk about it. We have to. If it's money, we got to know a little bit about it. So first I'll say opportunities are like buses, David. Just wait a while, another one will come by. It'll be fine. I also wish I got Amazon 10 years ago, but I didn't do that, right? And that would have been a much quasi safer bet than some of these. And so, I mean, it's the same for this. Non-fungible tokens, essentially, it's akin to art, right? But it's just electronic art. And yes, now you can verify the original, like you could verify Picasso. I've got a piece of art in my home, and it's marked on there. Number, I don't know what it was, number such and such of 180. So we know that it's only so many prints that were actually given for this particular piece of art, and I had number such and such of the print, and so we can ascribe some value to my physical piece of art because of that. And with NFTs, they're attempting to do the same thing. Do I think it's investable as a fiduciary financial advisor? No, gosh, no. Do I think it's an alternative? Yes, it is an alternative in the same way that physical art is an alternative. I don't recommend pieces of art to my clients to invest in because it is not investing. And this is not investing. It is speculative, but so is the secondary stock market. Okay, so let's just put this all in perspective. When you invest in a company, let's say Microsoft, well, you have to wait for Microsoft to go public before you can invest in Microsoft. They issue a public offering. That's the initial public offering, the IPO. If everyone buys into that IPO, Microsoft gets all that money. They get all that money because all of you and everyone else, the million people that bought shares, become partners with Microsoft. Just happens to be a corporation, but you become a very tiny partner of Microsoft when they do that initial public offering. Same thing happened to Zoom in 2019, October 2019. Initial public offering, everyone who bought shares, the money went to the Zoom people. They got to distribute it and grow their firm. That's the whole purpose of the public markets, so that they can grow their entrepreneurial endeavor, okay? But now that you own those shares and the institutions who bought in own those shares, when you saw Zoom trading, at $600 last year, that wasn't money going to Zoom. That was the secondary market. That was other people saying, I want to buy Zoom stock too. And I'm willing to pay whatever you ask because I want to buy it because I see it going up. And so it went from like $80 to $600 because so many people wanted a limited amount, supply and demand of shares that were issued. And so some market makers sold their shares, brokers sold their shares, which is why you can buy it immediately. You don't have to wait for David to sell his to say, I'll sell you my Zoom share. There are companies that just hold shares. They bought them and they're willing to sell them to the public in the secondary market. And so supply and demand creates that opportunity for Zoom shares to go up in the secondary market. Now Zoom shares are down to $300 and change. Why? The demand isn't as high. And so that same secondary market, which is where we participate, the demand has gone down, though the supply has remained the same. So the stock price is at 300 and change a share. Nothing really changes for Zoom per se until they issue more shares. And so we do dabble in the secondary markets all the time based on supply and demand. The benefit is we expect Zoom, because they've gone through this IPO process with the Securities Exchange Commission, we know they have a real business. They know they have real financial statements they have to issue every quarter at least. They do analyst calls. There's a business there, profits and losses that are real. With NFTs, with physical art, with Bitcoin, there is no business there. There's no headquarters for that. And so whether you're investing in a Picasso or you're investing in an NFT, you're relying on speculative factors of supply and demand. And so would you put your retirement money there? I wouldn't recommend it as a fiduciary advisor, because the way that we invest are going to be, if it's going to be in the secondary market, it's going to be tied to real businesses. That's the business that we are in. But if people want to do alternatives that way and take the risks, it could be baseball cards, it could be NFTs, it could be physical art, it could be classic vehicles. You have the right to do that. Or tulips,
Thank you.
yes.
And I don't know if anyone else has any other questions they want to put in there. You referenced Picasso twice. I had Picasso in my slideshow yesterday for class with that quote that I just put in the chat room. That was in class yesterday. And that's
Nice.
really about living well, right? Like what's
Absolutely.
your purpose, and then sharing your purpose, right? Engaging with the world. And only because Jason keeps bringing up Pablo Picasso that I'm going to share it.
I'm making it easy for you,
I had a
David.
piece of art with it also. And I was, as anytime someone talks about NFT, I keep thinking like, I'm going to NFT you right now and sell it, right? Like you're talking and I'm going to capture the image and sell it, right?
Yeah.
That this is a verified. So it is fascinating. Are there any of your clients that, are established enough when they look at their family governance, they say, oh yeah, we have 10% for fun, for speculation, and we're going to buy art or buy a boat or buy whatever. And that's just, we know we have income producing here. Does that come up with some people though? So if they see things like Bitcoin and NFT, they've got a little fun money, if you will.
Yes, it does come up, but understand that there are levels to it. And so it's speculative enough to buy a share of one company, right? Just to buy Zoom stock or Microsoft stock. As far as levels, I mean, that's taking a lot of risk, assuming you are not working for Goldman Sachs or JP Morgan and doing the analysis that Ivy League graduates spend 100 hours, working on per week to study to be a part of, their Wall Street firm. Assuming you're not doing that work, you are being pretty risky in and of itself. And so we have clients that have a little bit of money in a brokerage account where they do their own little, speculative investing. They're buying individual shares of stock and hoping it succeeds. That's as far as one really has to go. I mean, you pick the right stock, right? We saw it with Zoom. We saw it with Amazon some years ago. We saw it with even Microsoft. When I worked at a bank in the 90s, I had a client who would go to her safe deposit box and she had just counted her shares of Microsoft stock. And I asked her, how do you get wealthy? And she says, buy low, sell high. She's right. And I could have just been buying Microsoft shares from the 90s on till today, and I would have been pretty successful because I was using someone else's knowledge. So yes, we have clients that take some of their money and have a little fun with it. I have a client right now who is asking me about Coinbase and getting involved in the IPO. Is he going to invest all of his money in that or a large percentage? Of course not. And so when you're looking at your portfolio, and you should have a diverse portfolio, you have a lot of areas to fill in. There's going to be a real estate area to fill in. There's going to be a just generic cash portion to fill in. There may be a debt portion that you have to fill in if you're going to get the real estate. And then there's going to be a bond portion to fill in. And then there's going to be potentially a stock portion to fill in. And if you fill those in, and when you talk about stocks and bonds, you can get even more diversified. If you filled all those in, and then you're interested in getting even more risky, then absolutely find the next level. But this is why you typically see this with the wealthiest. That's the wealthiest that invest in classic cars, that invest in art, wine. Why is that the case? Because they're doing it in order. You don't see them doing that for their retirement money. They're way past retirement money. And so it
Someone
makes
just
sense.
asked me if I want to invest in whiskey. I shouldn't do it. So
I don't know your portfolio, David. Maybe you can.
I can keep it in my basement, they said, for like 20 years. It's going to be great.
Your portfolio might allow for it.
It's, I guess, another question related to the industry and how, you're finding your niche and your message and finding the people who, and it is growing, like you mentioned. It's, the IRA Act was 78 or whatever. I mean, really, really recent. When you look at it, this part of well-being, financial well-being, are we well as a society, as a nation? Like, we know physically we're not well. I would say socially we have some issues. how are we when you just think about it from societally, and then for opportunities, right? For businesses, for solutions, like you said, what are areas that people, maybe some last thoughts can think about in the business of well-being financially, things to look at that you think are important?
This is a big question. As a planet, we're sick, and we've been sick for a long time. Okay. Just as a country here in the United States, we have 80% of the wealth of the world. We have 5% of the population. Does that make sense? Well, it's nice we have microwave ovens, right? So it's good for us. But is that good for the rest of the world? I think many people around the world would argue that it is not good. But we also have the most guns, and so we can retain most of the wealth. And so how you think globally about wealth is probably the most broad way you can think, and ask yourself, are you part of a solution that you think is right, or does something need to change, and how could it change? And then it starts getting pretty political, and then it starts getting pretty personal, because we happen to be here. Many of you, many of us, were born here, and that's a great advantage, just by dint of that. And so to be global about answering that question, we are not well. Then just to be domestic about answering that question, we are facing the greatest wealth disparity since the 1920s between the haves and have-nots just in our own country. What do we think about that when we think about that? Are we well or are we sick? Well, certainly in the 1920s, that ended with the Great Depression. Could that end this way today? We don't know. I tell you what I'm excited about. I'm excited about most recent legislation that's trying something different. What we have had very often in the past, the recent past, really since the 1980s, was this idea of a trickle down. And that's not just real sort of in the arms of one political party. It's been essentially the ethos of what's actually passed. Tax cuts that have passed since the 1980s, continue expansion of the dollar, since then. And there's just been a lot that's been, if we broaden everything, it'll just magically happen that everyone does very well. And we've tried that experiment, and that experiment has gotten us to where we are today. And what's come out of recent legislation is this idea, which has been out there for a long time. It's Keynesian economics. How about we go directly and afford people the opportunity who we know are part of that side of the wealth continuum that are not doing well, and we send them actual checks, and we undergird some farms that never got any piece of this, and we work towards, now we're talking about the kind of infrastructure plans that are beyond just bridges and roads, but that are infrastructure in regards to communities that have not had as much opportunity as other parts of the country. That's a really fascinating, interesting way to look at infrastructure. And that conversation is being had right now in the halls of Congress and with the White House. And as I said, it's an interesting way to look at the issue we have with wealth disparity, to go from the bottom up instead of trickling down, to the extent we can even do that politically. And so we will see over the next months whether that kind of legislation can get passed, and we'll see over the next couple of years whether that makes a bigger difference than what we've been doing over the past 30 or 40 years. Very fascinating time.
Excellent. So a couple of thoughts I have there, and we got a couple more minutes. Do people have any questions? There's during times where an asset experiencing, so kind of a question someone had about quick gains, when things are doubling and tripling, and, do you have
David,
FOMO for your client?
Ashlyn was going to ask a question. She had her hand raised.
Okay, so let's get that one, and then we'll flip to Ashlyn. But I think I know Jason's answer on whether he has FOMO. I'm going to say no. I can tell by listening to him that they have their strategy right, and they have told me to let the whiskey go. I'm guessing he lets those things go.
No, if you got the stuff, then keep the stuff. I mean, come on. Here's the thing. Here's what the markets prove, and here's what the casinos know. We all have FOMO. We cannot stop it. We can hold it in for a while. We can act disciplined for a while, but given enough opportunity, we're going to act on that FOMO, which is why the casinos get to build new casinos all the time, which is why the markets, including our housing markets, our stock markets, it's why they continue to flourish and why would they build the buildings in New York. And the National Association of Realtors has 12 to 15,000 members just here in Northern Virginia, because they know eventually if they tell us enough and they put it in front of us enough and they reduce the cost of trading to zero enough that we're going to participate. And so that's something that one needs to sort of inculcate into your thinking right now on a conscious level, that I can't beat that. And so the only way that you can stay conscious about it is to order things. That's why I had mentioned, and while you're partially right there, David, put things in order. Do you have an emergency fund? How boring is that? You're a financial advisor with designations. No, emergency fund. Do you have an income that's ongoing, that's consistent, that you can believe in? Do you have insurance to cover emergencies you can't afford? And do you have are you taking advantage of your retirement account at work, which is tax preferred, and maxing the match, which is free money? Are you doing all those things? And if you're doing all those things, then you can start getting more risky into individual securities, and then yes, maybe even into NFTs, and get a great opportunity.
And I'm sorry, Ashlyn, I missed you because I had the wrong view up. So let's turn it over to Ashlyn.
Yeah, no worries. Jason, thank you so much for taking the time to meet with us. I have a question. In July, I'll be starting with Merrill Lynch Wealth Management as I continue my career as a financial advisor. So my question for you is, what advice would you give to college students who are starting to become a financial advisor, or just any entrepreneur who is interested in searching and investing?
Remember that first you work for an education, then you work for money, then people work for you, then money works for you. And so here in your first job, in your first year at Merrill, I hope you can survive whatever they throw at you, but know that you're going to work for an education in the same way that you came to Mason and you work for an education. That's what your first few years are like. And then eventually, if you do the work and just be consistent, the luck will follow. The harder you work, the luckier you're going to get. Okay. And you'll have that money. And if you do it well enough, they might put some people underneath you. And you may stay there. You may go to another firm and have people underneath you. And now you're making even more money because you're being paid to supervise. And as you're making this disposable income, you can get that money to work for you. But then you just do it in order. But I'll just reinforce the very first part. Work as hard as you can, as early as you can in life. And that will give you so many more opportunities later in life.
Thank you so much.
You're welcome.
I was slow. Repeat that. First, you work for an education.
Then
Then
you work for money. Then people work for you. Then money works for you.
Excellent. Thank you. Anybody else? I'm checking the chat. Are we okay?
I have a question, David. Jason, from an overall perspective, you took advantage of a lot of things when you were at Mason. How much of that was purposeful versus kind of just having it? Because one of the things I find is, how do you get people who are so busy with classes and so busy with everything, with just life, to step back and say, I need to be more purposeful? And what made you do that? That would be advice for students that we have.
A great question, Christine. And just to give the other students context, I worked full-time at the bank when I was also going to school full-time at Mason. My dad told me the more time you have is the more you're going to kind of squander it. And so he had no problem with me working full-time. In fact, it was in a way his idea. So Monday, Wednesday, Friday, I worked 12 hours a day. Saturday, I worked 8 hours or 4 hours, I think, to make the 40 hours. And so Tuesday and Thursday were my only days to be a student. And so I took off the tie and the suspenders on Tuesday and Thursday and put on a Mason baseball cap and a Mason slicker when it rained. And I was just a student. And remember, I mentioned earlier, I didn't plan to go to Mason. I actually had gotten accepted to William & Mary, and I was going to go there. And so when I made the decision to go to Mason instead, I decided, and that's key to life, you decide and the world will follow you. I decided I was going to have a college experience, which is why I had all my classes on Tuesday and Thursdays, and I worked 12-hour days on Monday, Wednesday, and Friday, because I didn't want to go, as my sister did, I didn't want to go in a suit and be a commuter kid on Monday for 4 or 5 or 8 hours, and then come again on the next day and do 8 hours, but have some night classes. And like, I'm the kid with the suit and the tie, and I'm just taking my class, and then I'm running off to work maybe, or I'm just going home. I didn't want that. And so I decided, I organized my life so that I had work days and then I had student days. And then on those student days, I looked at the stuff that was posted on the wall. What is it? Sing the American anthem for basketball games? I can do that. I'll try out. And I tried out, and I made a fool of myself, because everyone there, they were actually singers. Like they did that thing. And I'm sitting there, I'm like, you guys aren't kidding like me? But it was a college experience. I stood in the middle of what was called the Patriot Center at the time. I belted out the song, and I messed up the words, and I could see the sound guy laughing at me. But that was fine. I met my first girlfriend there because I took an opportunity to have an experience. I rode my bike from Manassas to Fairfax the first week because I wanted to ride my bike like I would have done at William & Mary. I only did it the first week, but I tried it. And so I'd say there's a lot of benefit to just throwing your hat in the ring for opportunities. That's how you can get excited by Mason. And especially if you wall off your work days from your student days, it'll help you feel like a student.
Great question. Great answer. Great answer. There was one more. I think someone had a question. There was a quote from, was it Jack Bogle or Vogel? Is he from Vanguard? Is he the index guy?
Yeah. I passed away as well recently.
He's selling his book, I think, with that quote, right?
What about his book?
Well, he's selling index funds, right? He's saying, do you see that in the chat box?
Yeah, I see it. You know, the cool thing about Jack Bogle and a few other luminaries is in 1975, it was May 1st, 1975, it's known as May Day. And that was the day that they were able to succeed with the SEC to standardize the amount it costs to trade, especially when you're looking at mutual funds as well. And Jack Bogle had this idea that you could have a discount brokerage, which is what they were. Vanguard was, Fidelity followed, and others followed, and not charge people extra because of some fanciful expertise. Well, you have to understand what was happening in the 70s and the 80s. In the 70s and the 80s, if you wanted to trade a mutual fund, you had to pay a good bit of money. If you wanted to trade a stock, you had to pay $70. It was a lot of money. Now you trade for free, and you had to buy a round lot of stock, which meant 100 shares. So imagine wanting to buy Amazon back then. That'd be 100 times 3,000, $30,000 and $70 for each trade. So you just couldn't do it. He democratized this idea of investing by saying, even on the mutual funds where they used to have what was called a load, so you'd pay up to 8.5% upfront just to get into a mutual fund. He would say, buy no load funds. Don't listen to that financial advisor. The only reason he's selling you that no load fund and defending himself or herself, but there were a lot of hims back then, as there are even now, was because they said, well, my mutual fund, as I can tell you, we have performed exceptionally well in the past 3 months. And it's like, if you looked over the course of years, an index fund performed better than that fund. And so not only did you pay more for that fund, you also underperformed the overall market. That was his argument back then. And it continued up through his death, and it continues through to today. So yes, if you are going to invest in order appropriately, and you are willing to go in and understand the benefits of using broad market index funds, you will pay the least, and you'll have a great opportunity to succeed over time. But I can worry about your FOMO tendencies, which we all have. And I worry about whether you're investing the right amounts. I worry about whether it's in the right vehicle. I worry about the right category. If you are willing to look into all that stuff, absolutely you can do it. Remember, this business is financial services. I serve my clients, full well knowing they could probably do it. And they're smart people. That's why they've saved so much money. They could probably do it themselves, but they need the time, they need the interest, and they need the stick-to-itiveness to keep at it. My job all day is to do all that stuff. And if people are willing to pay for that, then I'm here to do it. If they are interested in doing it themselves, much like my really first business at 13 was mowing lawns. And I would go knock on doors and I'd ask to mow people's lawns, which makes sense, except I didn't have a lawnmower. But I knew they did. So I was selling a service. I didn't have anything else. And if they wanted me to do it, I'd do it. If they didn't, they'd mow it themselves. And I'm in the same way in financial services. I can do your financial stuff with you, or you are free to do it yourselves. I tell you, the financial market has made it very easy for you to be able to do it, but buyer beware.
Yeah, I think, did Trevor, you want to ask a quick question before we wrap up? We've got time for one more. Jason, does that work for you?
Oh yeah, I've got some time.
Yes. Thanks for all the knowledge, Jason and David, the whole team. So my name is Trevor Alexander. I'm MBA graduate from Morgan State University up here in Baltimore.
Nice.
And good friend works at George Mason, sent me the link. So my question, Jason, is with the advent of all these new fintech apps, et cetera, at what point does it become logical to hire a financial advisor? Is it like a certain checkbox? Is it $500,000 in liquidity? Is it a lifestyle change? At what point can someone go from managing their own finances to, okay, it's time for me to give it to somebody else?
Well, most of the time, there are so many basics that you need to do before you really even can get a value from a financial advisor. So I would say start with the basics that we mentioned. Get your income, get your emergency fund. And when you're over and above your emergency fund, you're starting to look into investing in the stock market, that may be a good time to call an advisor. Now, it's very tough to get an advisor that knows anything that they're doing, that has credentials and the like, unless you have $500,000. But I'd say go to the XY Planning Network. I just put that in the chat. Okay. And there are a number of advisors there, in fact, about 1,000, who are essentially younger advisors who look at the world in a similar way that I did when I started my firm and said, cannot we create a model that allows me to work with my peers who, by the way, wouldn't have $500,000 if I'm in my 20s and in my 30s. And I could maybe charge a monthly, retainer amount of a few $100 or something, and they can get value for as long as they'd like to get it. And so that question was answered by the XY Planning Network. They started sometime, I think, in 2014. I became affiliated with them in 2015, so pretty early on. I was member number 60, I think. And now they've grown to 1,000 members of essentially financial planning firms that are credentialed. So no one on there is without their certified financial planner designation. But they are also committing to having these alternative models where you can come in without that $500,000 and get the advice that we all need. We all need it. It's just who can essentially give it to us with the business model that most of these advisors have. Your colleague who's going to be going to Merrill Lynch, they don't really have a model that I know of where they can get an advisor. You might be able to call into their Merrill Edge and get a phone person to work with you and do some of that. Vanguard is similar. Fidelity is similar. You can come in now with $50,000 or $30,000 and still get someone on the telephone to work with you. And if you're at that level, then I recommend going ahead and doing that because they're typically CFPs. And that way you'll get some of the advice to get going. But generically, before you engage with any of those, I'd say if you don't have an emergency fund, 3 to 6 months of your expenses set aside already, you shouldn't even really be looking at the market as an important vehicle in your portfolio yet. You should be looking at your savings account as the first vehicle.
Thank you very much. Thanks. Excellent.
Yeah.
Excellent. Thank you. And I think that's a great question to end on and a great answer because like all of well-being, it's intentional. It does not happen by accident. You have to think about it. You have to plan it and be consistent. And over time, your level of wellness will improve. So thank you so much, Jason. People can Google Jason and his company because there is great content out there.
Yep.
He hosts a bunch of Zoominars with really interesting people talking on great topics. So definitely look for him. Thank you, everybody. Thank you for thinking about well-being, the business of well-being, your role in it, as Jason pointed out, at the micro and macro level. And we hope to see you all out and about for more activities. We will leave this on for 5 minutes so people can go in that chat box and copy and paste whatever they need to get. And then we will turn it off. Thank you all and be well.
Thanks everyone for having me.
Thank you so much.
Thank you.
Thanks, Jason.
You bet. It's good to see you, Christine.
Good to see you.